Good afternoon, this is Madeline Henry from Oxford Economics. Can I start by welcoming you all and thank you for joining the Oxford Economics webinar on the implications of QE and the outlook for the European consumer. For those of you who are new to Oxford Economics, as a brief introduction, we were founded in 1981 as a commercial venture with Oxford University and are now one of the world's leading independent global forecasting and advisory firms, providing analytical tools, forecasts and reports on 200 countries, 100 industries and 3,000 cities. Before we get started, just a few housekeeping points. Dr. James Nixon will provide a 20 to 30 minute presentation and then we will be taking questions. Please can you remain on mute so there are no disruptions throughout the webinar. If you would like to ask a question, there should be a drop-down box at the top of your screen. Please use the chat icon that is in the drop-down box and send a private message to the host Adrienne or myself. This can be done throughout the presentation. That's all from me. I'm now going to pass over to James.
Okay, well thank you very much and good afternoon. Thanks for everybody taking the time to listen in this afternoon. Essentially what I want to do today is really just sort of update people on our thinking on the latest outlook for the euro area and also to have a look a little bit at some of the implications of QE. And as we've indicated, I think the slant of the presentation hopefully will be to draw some conclusions about the outlook for the European consumer. So really, three things I'd like to sort of try and do. The first is really just very briefly set what's happening in Europe in the global context. Then really have a look at the eurozone and have a look at some of the implications of QE. And in particular, when it comes to discussing the euro area, really try to make the case that I think something we've argued in the past, that we see really Europe as being a case of facing something of probably a global slowdown, but that against that global slowdown, what we see offsetting that weakness in the global environment is really a sense of domestic healing and signs that really the domestic demand in Europe is on a much stronger footing. So really to kick off, the first slide, just to look back at the relationship between world GDP and world trade, which you might like to think about. This is a slide that illustrates effectively what we like to think of as the world trade multiplier. And it really illustrates that typically world trade grows by something like 4 times as fast as what we see in world GDP. And in many ways, what's the defining characteristic of the current environment we find ourselves in the global economy is one where that relationship seems to have broken down. And despite a recovery in activity across a number of nations, world trade has really remained remarkably sluggish. And we see no sign of any acceleration in world trade. And that's another way maybe of sort of coming into some of the literature that's been articulating that what we face is really something of a secular stagnation in the global economy. In the face of what is essentially weak external demand, there's very little incentive for firms to invest. And so that starts to become a rather self-reinforcing cycle. And that's the sort of the current equilibrium that we find ourselves in. While we can make a number of arguments as to why that might be the case, I think it's useful perhaps to sort of have a look at the impact, for example, that some of the policy changes in China have had on the euro area, and in particular look at the Chinese response to the financial crisis. So just taking the chart on the right-hand side for a second, a very simple picture, just looking at what's been happening to European exports to China in nominal terms, and this is a chart drawn in levels. And you can see that really from about 2009 onwards, there's this very sharp increase in European exports to China. And this really reflected the impact of the Chinese decision to bring forward a lot of their investment spending in their current 5-year plan. And you can see there was a big increase effectively in European exports, particularly of capital goods. And then from about 2012 onwards, really that strong growth sort of leveled off. And it's only relatively recently that we've started to see some signs that maybe some of that growth has started to come back, but it's still very tentative to a certain extent. So really, I think we have been in Europe obviously adversely affected by that slowdown, but there's a sense that to a certain extent Europe is already insulated from any further slowdown in the global economy within certain boundaries, because we've already had, I think, a lot of that slowdown. The other sort of main global development is obviously what's been happening to the oil market, and we've seen a very sharp decline in oil prices. And this is just a picture that I think tries to put, for example, what's been happening in the United States with the advent of shale oil into perspective. So you can see what's quite useful. This is weekly data that looks at US oil production, and it just illustrates this really phenomenal run-up that we've seen in US oil production up to over there should be 9 million barrels a day. And what's interesting, I think, about this chart being weekly data is that we can actually monitor this. And obviously, with the decision of a number of companies to cut back their capital spending in response to the decline in oil prices, one would expect to start to see this roll over. And that's something that we're monitoring at the moment. So really, we've got those two things taking place in the global economy: the overall level of weak external demand and the very sharp decline in oil prices. And really the first thing I think we can say in terms of the impact on the euro area is that decline in oil prices has obviously imparted quite a negative deflationary shock to Europe. We continue to try and make the distinction in Europe between negative rates of inflation, which is what I think we have at the moment, and outright deflation. Really the distinction being that we want to reserve outright deflation for an environment when the level of prices is falling in general, whereas at the moment, obviously, in Europe, we still have higher core inflation. But I don't think it's an underestimate to say now with oil prices around $50 a barrel, the impact of that shock is going to be sufficient, really, to keep European HICP inflation negative, probably for most of 2015. And it will only be towards the autumn when we start to see the decline in oil prices drop out of the annual comparison that oil prices may start, headline inflation may start to edge back into positive territory. But standing back for a second, in terms of the European growth outlook, there's obviously, I think, particularly if you read a lot of the Anglo-Saxon press, a sense that the eurozone recovery has lagged behind what we've seen in other advanced economies. And that would certainly seem to be borne out by the data. We've seen European growth pretty much significantly slower than in the US and in the UK, for example. And what's interesting, I think, is that while some of that has been, in terms of the breakdown, most of that weakness, for example, has come pretty much from the investment side. And that's particularly true, I think, in terms of our current forecasts. And that really reflects, I think, the impact of what has been another external shock to hit the euro area, in particular coming from the sanctions that have been imposed on Russia, and the way that has created an uncertainty shock that has led to at least the postponement of a lot of investment plans. And that was something that was evident, I think, in effectively the final data that we've seen really for the third quarter for the last year. Part of the reason, I think, for that weakness in activity over the last couple of years compared to the rest of the world has really been what I think has been, if you like, the impact of monetary policy. So this is a slide just making the case that you can see that from about middle of 2012 onwards, the ECB really presided over quite a significant reduction in their balance sheet. So in contrast to the monetary policy being pursued by other central banks, what we've seen is the ECB actually preside over quite a significant tightening in lending conditions. And arguably, that tightening has been one of the features that has been reflected in a sustained depreciation of the euro, particularly against the dollar, excuse me, which has seen the euro appreciate by something like 15% up until the spring earlier this year. And that, I think, that appreciation of the euro largely explains a lot of the weakness that we've seen in Europe historically over the last couple of years. Critically, of course, the key thing going forward is that we've now seen something of a volte-face in policy from the ECB, really stemming from around March last year, when the ECB first came clean and admitted that even in 2016, inflation was going to be a long way short of their 2% objective. We've seen successive cuts in interest rates, and with the decline in oil prices taking inflation negative, that process has really reached its culmination. with the announcement of QE from the ECB earlier this month. I think in terms of the question, will QE work, the point we would make, first off, is that to a certain extent it already has, and the expectation of QE over the last 12 months has really led to quite a sharp decline in bond yields and in the exchange rate over the last 9 months or so, and that has had quite a significant impact on the economy. Looking ahead, the plans for the ECB clearly to buy a mixture of assets to expand their balance sheet up to around €1 trillion, and those will include sovereign bonds. We think there will be considerable pressure to continue to push interest rates even lower going ahead. Equally, I think the key thing really for the ECB, and perhaps what makes the difference for the ECB's QE in this environment, is that while the other central banks were undertaking QE at times when the economy was effectively falling into recession, and so QE was designed to effectively cushion the depth of that recession, the interesting thing about the ECB is that their QE is coming in and impacting at a time just when the economy is starting to pick up. And so the ECB may potentially get more bang for their bucks in this period. Finally, I think it's important to say that going back to the first chart, looking at what we've seen in terms of world trade, we've arrived at a situation where, with world trade growing so slowly, what happens to the exchange rates has become something of a zero-sum game. And what's interesting about the ECB introducing QE at this time is it looks like the central banks in Europe are actually getting ahead and winning this game of competitive depreciation. So we think that looking ahead, probably the exchange rate will continue to be a key transmission channel for the central bank and for growth in Europe. We should start to see exports begin to advance. At the moment, they may be being held back by that weaker growth coming from Russia and from the uncertainty shock, but that should begin to wear off and exports should power ahead. I think critically, the lower exchange rate should also begin to impact on goods prices and really keep core inflation in a positive environment. So again, we don't really see the euro area slipping into outright deflation. Taking a step back, if you like, from those sort of developments, the theme we have been running and trying to push really for the last 6 months or so is to say that even before the fall in oil prices and even before the ECB adopted QE, there was plenty of evidence that the economy was beginning to show signs of perhaps gathering momentum. And after what has admittedly been a long time, there were signs that domestic healing was starting to take place. So this is a picture just looking at what's been happening at employment in the euro area. And you can see that, for example, in the second quarter of this year, employment growth was the fastest it's been for 6 years. And what's important, I think, is really the sectors that employment growth is taking place in. We've labelled this retailing, but that's really the sort of the traded goods sectors, hotels, catering, these sort of activities. And clearly those activities have to be very closely related to the consumer. And so even in the employment data, I think in the middle part of the year, we saw evidence really of the consumer beginning to gather strength. That sort of sense of domestic healing is reflected, I think, across a number of indicators, and we've been picking it up now for some months. Here's some charts taken, for example, from the ECB's bank lending survey that indicates, for example, that in terms of the credit standards that banks are applying to mortgages, there's recently been a net easing of those standards, and consequently, commensurate with that sort of improvement in the climate, and we have seen survey evidence suggest that there is a demand for mortgage lending beginning to pick up. That improvement, I think, really is reflected, for example, in an improvement in consumer confidence, which you can see is quite closely related to consumption. And so again, there is this sense that really the whole consumer side was beginning to move and lead through to stronger consumption growth. Part of that, we think, is looking ahead now, is going to be a particularly German story, in the sense that we do see, when we look really here for a correlation between unemployment, which to all intents and purposes is the cyclical low in Germany, against the current rate of negotiated wages, there does seem to be scope for a considerable improvement in wage growth in Germany. And that's, I think, one of our big calls that we should expect to see coming forward in the next 12 months. So really that improved confidence, really, leading to critically an improved labour market environment, the next stage should be that should start to feed through into stronger wage growth. So in terms of the outlook for the domestic consumer, I think really all the things are beginning to fall into place. In terms of the nominal income generating process, we should see stronger wages and we should see stronger employment. But on top of that, we then have this quite sharp decline in inflation, and that should lead to quite a substantial increase in real household income. And you can see from these charts that what we're really predicting going ahead is some quite a significant upside in terms of the forecast for really consumption as that begins to drive the economy forward. And in particular, compared to where we are now, I think a lot of that story will be coming through in Germany. And we really do see scope for maybe the first time in a number of years, some real signs of real strength perhaps coming through on the German consumer side. The good news, I think, is that to a certain extent, part of that story is already falling into place. We saw that today with, for example, the latest retail sales figures and the service sector PMI. And when we aggregate up all of the data for the fourth quarter, our analysis suggests, looking at our GDP indicator, for example, that the euro area probably grew by something like 0.5% quarter on quarter in the fourth quarter, largely through stronger consumption spending, but also potentially backed by an increase in industrial production. And those sort of factors, for example, mean that Europe is on course potentially to grow at its strongest rate for 3.5 years. Finally, if you like, circling back and looking at some of the more broader implications of QE, obviously the interesting thing about QE is that the central bank, as I said before, are acting, coming, if you like, late to the game and acting, to a certain extent when other central banks are moving in the opposite direction, and that potentially gives them a greater bang for their buck. But they're also acting and providing increased liquidity just at the time when the economy begins to be picking up. And we think there are already signs that that may starting to be effective. Certainly, when we look at, for example, the spread of interest rates across the euro area, this has been an index, for example, that's been referred to as financial market fragmentation. And you can see that despite the low level of, for example, policy rates, interest rates in other European countries have remained relatively elevated. But what's interesting, I think, really about the last 6 months or so, is you can see that interest rates are beginning to decline. And then on the right-hand side, again, coming back to some survey data taken from the ECB Bank Lending Survey, this is one of the sub-questions that really asks the banks what they see as the main factors driving their new business. And the interesting thing on this slide, I think, is really the red bars, which are the response to fixed investment. And you can see that over the last 12 months or so, it's pretty much been, to a certain extent, a recycling of capital, things like mergers and acquisitions, debt restructuring, that's largely been driving a lot of the lending activity. But the most recent survey, for the first time, we began to see fixed investment starting to drive new lending activity. And that very much chimes with our sort of forecast. So overall, I think we see an environment where 2015 should be a year where activity is largely driven by the decline in oil prices and the boost that will give to consumer spending. But off the back of that, we expect the investment cycle to strengthen and stronger investment to be very much part of the story for 2016. What that means, I think, is that we now have greater confidence in what has been, I think, quite an upbeat and bullish story for activity in 2015. And despite the global slowdown, we see that as being largely to do with an outlook of stronger domestic demand in Europe as the consumer begins to find their footing. And while a number of institutions have largely been revising down their growth forecasts, with the European Commission, for example, down as low as 1.1 for this year, we're currently have a forecast for growth of around 1.5% for 2015. And indeed, when we factor in the latest increases in QE and further depreciation of the exchange rate, there's probably scope for that figure to even be revised upwards when we release our February forecast later this month. So generally, while the consensus is moving down, we think actually the growth prospects for Europe are definitely increasing to the upside. So that really is, to conclude my presentation, what I wanted to do in terms of lay out the sort of the outlook for Europe. I've tried to place what's happening in Europe really in the international context and sort of indicate that clearly at the moment the global economy is still characterized by this real lack of dynamism in world trade, and that means that to a certain extent what's happening on the monetary policy side has become almost this fight for competitive depreciation. But with the ECB adopting QE later than some of the other major central banks, it does seem as if the ECB has stolen the march in that game and appears to be winning the competitive depreciation. On top of that, the declining oil prices will act as essentially the same as a VAT cut to consumer, and that promises to significantly boost consumer spending in 2015. So overall, we think we're on course to see a very dynamic recovery in 2015 and 16. Some of these positive factors begin to feed through. So I'll stop there and open it up for any questions that people might have.
Thank you, James. Just a reminder, if you would like to ask a question, there is a drop-down box at the top of the screen. If you press the chat icon there, you can send our host Adrian a private message. We've already had a few questions in, so I will kick off. You've told a quiet and an upbeat story about the euro area. Is this essentially a German story, or will the benefits be more widely spread?
I don't think it is only a German story. I think obviously in trying to tell an aggregate story, as I've just done this afternoon, Europe, there is quite a wide disparity across Europe, but it's by no means solely a German story. I mean, I think what we've already seen is that there are a number of other countries where this dynamic is evident. That's most obviously true in countries like Spain, for example, where GDP grew by 0.7% in the fourth quarter. But across Europe, even in countries perhaps like France, the key thing there, I think, is that we feel there's a lack of competitiveness, and the corporate sector is really facing a situation of depressed margins. But critically, the improved funding costs and the depreciation of the euro should actually be quite a positive, even for, for example, the French economy, and that's something that should help investment prospects more towards 2016. So we think this is a story that, although it will be reflected differently in different countries, should be applicable across Europe.
Okay, another question. How open-ended do you think the ECB's asset purchase programme will be? Do you see the ECB continuing to purchase assets after September 2016?
Okay, so at the moment, obviously the ECB is committed to continue purchasing a wide range of assets with a view to increasing its balance sheet towards 3 trillion, with those purchases expected to continue until effectively the autumn next year. I think our view is that despite what the ECB says, which is that those purchases will be reviewed, whether more is needed, I think we find it hard to see the circumstances in which the ECB would actually purchase more than they're currently committed to. By the time we get to next year, for example, I think the oil price fall will have dropped out of the annual comparison, and either it is the case that inflation is moving back in the right direction, and it's evident the economy is recovering, in which case QE won't be needed anymore, or we'll have a situation where if the economy is still floundering and inflation is very weak, I think more of an argument we made, well, QE simply hasn't worked, and so why do more? So we feel, I think, that to a certain extent this is a one-off shot, and we're very unlikely to see further purchases beyond what's already been announced at this stage.
Okay, another question just in. The former ECB programs increased a lot the monetary basis, but M3 did not increase so much, and the LTRO did not have so much success. Therefore, does really the eurozone need more liquidities, and don't we face the risk banks simply increase their excess reserves as they used to?
I think there's a variety angles, I think, being driven out of this question. I think the key thing to appreciate, I guess, about a lot of the ECB's prior liquidity operations is that they weren't necessarily, I would argue, designed to expand lending. Rather, they were designed in many ways to simply fill the gaps that had been made when the banks lost access to a lot of wholesale funding. So they were almost designed to sort of keep the banking sector afloat and stop an implosion. And from that point of view, the provision of the ECB liquidity, I think, has been very successful. Going forward, what's been really critical for Europe is really the commitment from the ECB to make clear that it is prepared to be the lender of last resort to both the banking sector and, to a certain extent, the sovereigns alike. And that's obviously been at the heart, I think, of the diminished sense of currency risk that we've seen really since Draghi's speech in 2012. The final thing I think I'd say on this topic is, in many ways, this may well also have been a factor in the ECB's decision to launch QE, is really the big thing we've seen last year was the comprehensive assessment and the ECB's AQR exercise. Now, I think you can make a case that given that the banking sector went out and raised the best part of nearly 200 billion of what was new capital or new capital equivalent, we've had a dynamic in Europe where the banks have been in a position where they've been preserving capital and not been willing to lend. Critically, I think that is about to change. The best thing you can say about the AQR is that it's behind us. And I think what we're seeing in the survey data and what I tried to show when I showed you the chart earlier on, looking at, for example, what's been happening in terms of from the ECB Bank lending survey, the critical thing is that now the ECB provision of liquidity is going to come at a time just when potentially loan demand is picking up. So I think there's a real chance that the ECB may just be in a position where they've just lit the blue touch paper at just the right time.
Okay, great. Another question in, what are the risks of Greece debt negotiation with the ECB?
Well, I have deliberately tried to steer clear of Greece because I think what we will do, just as a small advert, we will be hosting a couple of webinars over the next 2 weeks on Greece. And partly that's to say that to answer that question properly is actually quite a long task. I guess 2 points I'd make. The first is that we think the real risk will probably come later in the summer, in June and July, when Greece faces significant redemptions. And in our view, one way or another, Greece probably has enough cash on its balance sheet to meet its redemptions up until then. But once it gets to July and August, it faces between 6 and 7 billion of redemptions. And without external funding, it's just not obvious where those redemptions will come from. In the short term, the immediate risk, and I think this is where the question is really being driven, the immediate risk is, can the ECB continue to finance the banking sector? And I think our view is that some deal will be struck that means the ECB continues to provide liquidity. Now, that may not be in exactly its current form, so it may be that the ECB begins to reject, for example, the bonds that the Greek banking sector are placing as collateral of the ECB, and it may mean that we see the banks in Greece having to make much greater reliance on the Greek central bank's emergency liquidity provision. But I would be very surprised if, for example, the ECB felt politically it was in a position to really take a view and take a decision that would place Greece in some severe financial stress. That seems to me to be a political decision, which is well outside the ECB's remit. Okay.
What about medium-term projection? Any potential risk on the downside?
I mean, the medium term, I guess, the reality is that a number of European countries, France and Italy, and a number of others, still have to undertake some quite significant structural reforms in order to embed some dynamism back in their economies. So it's definitely the case that the kind of filliping growth that we're expecting over the next couple of years may prove to be temporary. And I wouldn't want to shy away from the comments that we continue to believe that the euro area as a whole probably faces a decade of adjustment in order to undertake those reforms and get their house in order. Having said that, I mean, it will be immeasurably easier to undertake some of those reforms, reduce some of the structural imbalances, and tighten fiscal policy in an environment where the economy is growing again, and decent employment growth is definitely being generated. For me, the big risk is behind all of this, that a number of countries, and Italy in particular stands out, still have relatively high debt levels. And I think the way I would best put that is I think that it means there's very little sort of fiscal headroom in a lot of European countries. So if at some point over the next decade we were, for example, to have a significant global downturn that pushed the euro area back into recession, then I think the impact of that on the debt levels in some European countries could actually be sufficient to push them onto unsustainable trajectories. So that's my concern, that the euro as a whole, to a certain extent, is in the last chance saloon. And the gamble is that we have to somehow get through the next 2 years without another global recession.
Okay, I think we have time for maybe one last question. As we have projected the growth to be 1.5%, would this be inflation-driven growth on the back of quantitative easing, or real growth? Which region, industry sector were primarily responsible for the growth?
Well, I think we've indicated that I don't think we see this as being particularly inflationary. I think in contrast, we do see the decline in oil prices as really being a genuine boost to consumer spending power. And I think that is going to largely come through in terms of increased consumption. And as I've already indicated, I think at the moment it's mainly the sort of the small items, the consumer non-durables, the sort of the traded sector, the hotels, catering, things like this. That's where we're starting to see most of the movement come through. I think the important thing to stress, however, is that what we really see for Europe is that being very much the sort of if you like, the thin end of the wedge. And as the recovery gains momentum, confidence improves and unemployment continues to fall, particularly if we start to see a pickup in wages in countries like Germany, then some of the more durable sort of sectors should also start to join that recovery. And then finally, we should start to see the capital goods spending and the investment spending begin to impact later in 2016.
Right, okay, great. There are a few questions that we haven't had time to answer, but we will come back to you separately on email. Thank you all very much for attending. If you would like any further information regarding Oxford Economics, please feel free to get in contact or visit our website. The recording and the slides will be sent out later today for those who registered. Thank you again and have a good day.